Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, excuse me. Welcome back. And great to be here. There's a lot of stuff going on. Plenty to talk about. We've got a seminar coming up. It's actually on Thursday. There are only 22 seats remaining. And so if you want to attend that, it's going to be, the title is The Key to Successful Investing, Choosing an Investment Strategy That Suits You. And we're going to be looking at a couple different strategies and some ideas that you can use to try to help you succeed in the market by following these strategies that match your investment personality. And there are a couple investment personalities. Actually, there are shades of two major investment personalities out there. Kind of like the 50 Shades of Grey thing, except that this is G-rated. So you've got two major styles, two major strategies. One would be deep value. The other is aggressive growth. And then you've got everything between. Lots of stuff in there. Value stuff is typically, those are your dividend-paying stocks. Bigger companies, been around for a long time. Maybe selling at prices that are supposedly undervalued. It depends on who you're talking to, actually, what their opinions are. And then you have people that invest in stocks that don't even have a product yet. That would be the super aggressive growth. And like I said, there's everything in between. So they all have one thing in common, is that they're investing in stocks, and all stocks are volatile. So one of the things you want to do if you're looking at, trying to be able to sleep at night when you invest, which of those strategies that are out there have a good chance of getting me to where I need to go without keeping me awake at night. That'd be nice, right? That's what we're going to be looking at. Got a couple of newer tools I've been experimenting with. I'm going to show people those tools and see what they think before I actually start to implement them. Just, hey, take a look at this. How does that look? And we'll take a little vote right there in the seminar. So anybody attending this seminar is actually helping form the investment policies for those investors that are currently with me, because we've actually got to make a couple changes. It's paperwork, basically. And any new people coming in. There's a huge increase in the amount of paperwork that is being required. Excuse me. It's being required by the Department of Labor. And it all ties into this seminar. And as I promised earlier, I'm going to get there about 6:30, and I'm going to show a couple different things. One is the really aggressive, the Look Out for the Bull website. That's a trend-following website. That would be the aggressive growth type. And the way that I do it, it's actually more of a medium aggressiveness. It's not a super aggressive. So I'm going to talk about that. I'm going to show how you use that, how I'm doing it. I run about a little over $1 million, which is nothing, by the way, in a fund using the strategies I'm going to be talking about the first 15 minutes. And those strategies can be found on Look Out for the Bull website. That's the website. It's $20 a month. The training sessions are only 4. If it takes you more than an hour to read it, it's because you're fooling around. Yeah, just follow those and follow the rules, and you should be okay. And anyway, we're going to talk about a little bit about that at the pre-seminar, and then I'm going to take about 10 minutes and talk about buying CDs. You can buy CDs from brokerage firms, and you can have multiple CDs from banks all over the country and have more than $250,000 invested in CDs and still have it covered by FDIC insurance. A lot of people don't know you can do that. So I thought this would be a good idea, a good time to do that, because interest rates on bonds are so low that to get anything above a 3%, you're going to be holding something that's 20 years or longer in maturity, and that's not good. Why is it not good? Well, look at the iShares. Barclays at the 20-plus year Treasury bond fund. That means they are buying Treasuries that are either 20 years or old or longer before they mature. And that fund in July was at $143. It's at 121 now. It's down 15%. And we've been talking about that for several years, on this program. That's why the bond portion of your portfolio is key. You need bonds for a reduction in volatility, although you hear something like that, doesn't seem like it's much of a reduction, and it's not. Bonds are tough. They're complicated. You got to know what you're buying. A lot of people read the word bond or a government, a treasury bond, and they go, oh, that's got to be safe. Really? Well, if you consider safe being down 15% in less than a year, well, I guess it's pretty safe. If you don't consider that safe, you'd better learn a little bit about bonds. And I think the CDs are actually a very good option given current interest rates. You can get a 5-year CD, typically 10 to 20, even 30 basis points higher. That's, 0.3% higher than a treasury that you have to wait 10 years for maturity. So 5-year CDs are actually paying more than 10-year treasuries are. And that's where I think the sweet spot is in fixed income. And I know a lot of people are not getting excited about 2.5%. Well, I got to tell you, if outside of that, you just have to take a lot more risk. You can get higher returns, but you've got to take higher risk. And I wouldn't be trying to do it with bonds. I wouldn't be trying to, a dividend-paying stock portfolio, yeah, that makes a lot of sense. But a bond portfolio trying to beat 3.5 or 2.5% over a 5-year time period, that is going to be incredibly difficult to do. And so I think that makes a great option today. And as interest rates go higher, if they go higher, then those CD rates will go up, and you can sell some of the. Well, actually, if you build a ladder, let me back up here a second. I said 5-year. That would be the maximum. I would buy CDs that matured in 2 years, 3 years, 4 years, 5 years. Actually, next year, then 2 years, 3 years, 4 years, and 5 years. It's called a ladder. We build a CD ladder. When the CDs mature, they're going to reinvest, and when the 1 year CD matures, you're going to invest 5 years from that date. You know what? I'm just thinking about this. Somebody driving in their car probably has no idea what I'm talking about. It's a lot easier at the seminar because I can draw it up on the board or up on the screen, and it's called a CD ladder. But I think it's a pretty good idea given the interest rates that we're facing today. And what else are we going to be talking about? Actually, we'll take questions. We always open up. I'll stop. That's only going to be, those two topics are only going to be like 10 minutes apiece. We'll stop at the real seminar, choosing investment strategy that suits you. I'll show you a couple of strategies that I like that are a couple of my favorites. We're going to talk about how to put those in a portfolio to match your personality. And that's really, when I say match your personality or choosing an investment strategy that suits you, what I'm really talking about is how much volatility you're willing to put up with. That's what we're talking about. How much volatility are you willing to put up with? How much of a fluctuation in your account value are you willing to see? The higher the fluctuation level, the higher the potential return in most cases, but the higher the risk. So you got to try to figure that out. I've got some recent data that's just been published that I really like a lot. It's giving projections on where a lot of financial models that have been built and used for quite a long time successfully. And I've got access to the data now, so I'm going to bring that and show you what you might be able to expect, or at least what you can expect, and how they calculated that. That's a big deal. I see a lot of firms out there using data going back, this is going back to the Depression. Well, you know what? For the first time since actually the company was born, you've had 8 years back-to-back sub 3% GDP growth. That's never happened before. So if that's never happened before, and you're running, I don't care if you're running it back to the Depression, this has never existed. So the data that you're using is not that good, especially if you're using it over that entire time period, because that entire time period was really good for stocks, probably better than they're going to be over the next 5 years or so. Well, how do you fix that? How do you fix that error? And the answer is you can't fix it completely, but it doesn't mean you shouldn't try. And the method that we're going to be talking about, I'm going to give a handout. I'm going to give the handout so everybody can see it. It explains how that method was achieved, and I think it's a big improvement. What I think is really funny is this method has been around since 1989, but it really hasn't got much traction. People, I know why. I know why, because the projected numbers using these models are significantly lower than the numbers if you use the historical data going back 30 or 40 years. So if you're walking into an office, if you were selling something, what would you rather show? Would you rather show something that's got a 25% higher return, or would you rather show something that's got a 25% lower return? Not a surprise, until you invest in it and then the lower return shows up. That's the surprise. And that's kind of the surprise you want to try to avoid if you can. So anyway, you can go to my website and sign up for that. It's bullingtoncapitalmanagement.com. Yeah, Bullington Capital Magic. Better strike that. It's management. No magic. Just probabilities. That's what we focus in. We strive for excellence, not perfection. Those people that strive for perfection, man, you have to be doing this a long time, by the way, to understand what I'm talking about. But when you strive for perfection, you've got a lot of risk. That's what happens when you try to be perfect. You don't decrease your risk; you increase your risk. And anybody that's been in the stock market for any length of time knows exactly what I'm talking about. Those people that haven't been in the stock market for a long time are wondering what the heck I'm talking about. Striving for perfection can be the enemy of profitability. And that's a really deep phrase that we are not going to get into today. Maybe I'll come back to that in a future show. By the way, if you'd like to call, if you have a question, 216-901-0945, 216-901-0945. And I'd be glad to take any calls you have regarding investing, budgeting, that kind of thing, financial planning into retirement. Actually, you can call in with comments on how you think the president's doing. I'm just kidding. We don't want to do that. Don't want those calls. But things are actually going pretty good. I mean, it has nothing to do with the current administration. It has more to do with the economy. I shouldn't say it has nothing to do. I think businesses, big businesses, are much bolder. They're willing to take more risk under this administration. And I think it's because they don't fear the regulations growing, and they're anticipating that regulations are going to subside. And so I get a report that comes from Bloomberg, which is one of the biggest data providers to institutional management firms all across the world. And they've got this thing called an Orange Book. And it's a great big interview of all the top Fortune 500 CEOs. And they just tell you what they're thinking. And it's a couple paragraphs on each one of them. That thing is a super long publication, by the way. But it gives you a great idea into the insight. You can kind of skim through it, see what their sentiments are, and just kind of measure, how many of these guys are positive? What are they doing with their money? 4 or 5 years ago, they were all buying back shares. They thought that buying stock in their own company was the best investment that they could make. And I get it. You got high regulations. You got banks not really lending money to people unless they really don't need the money. Yeah. But it was harder to get financing. And oftentimes buying back the own stock could increase the earnings per share faster than investing in a project. See, when you buy back your own stock, when you have fewer shares outstanding, you have fewer shareholders to split your profits among. So your profits go up on a per share basis by doing that. And that was in vogue. And a lot of mutual funds and a lot of exchange traded funds made a lot of money by buying those companies who were buying back their own shares. Well, that was a trend. And now it appears as though the trend is they're spending money on projects instead of buying back their shares. And incidentally, the balance sheet of the Russell 1000 is one of the best. It's in one of the best positions that it's been in its history, as far as the amount of cash they have available, as the amount of debt that they have available. So the amount of capital, it's there. The amount of capital is there. They just, companies just need projects to invest in. They need confidence from the government that they're not going to do something and the government's come and regulate it and take all the profit out of it. And that can happen. But I see I've got a quick caller here. I got John. Johnny, you got a question for me?
Yeah, I started investing seriously in 2010, and at the time, in June, the stock market was at 10,373, the Dow,
Yep.
and the Hang Seng was at 22,212. Since then, the Dow has doubled, and the Hang Seng's only gone up 20%, 10%.
Right.
So why is it that the Chinese were always upset when they were their growth was as low as 7%, and we never came anywhere near anything like that? And again, the question is, why did our market double and theirs only gain 10% under those circumstances?
Well, what you're getting to see, what you're getting to experience firsthand, is that markets don't really pay attention much to fundamentals over a fairly long time period. Now, if you give it a 10 or a 20-year time period, the market will generally reflect whatever happened in the economy, but not always.
Yeah, by the way, when you mention that, I'm thinking of 2010 when the market did nothing.
Yes. That was just a 10-year negative period. So timing has an awful lot to do with that. And I am so glad you brought that question up, because one of the things I wanted to talk about today, too, was when you're investing in other asset classes other than the large United States stocks and the funds that hold them have outperformed almost everything over the past 5 years. And that is not always going to be that way. At some point in time, a lot of the foreign and emerging markets, they are going to catch up. But trying to guess when that's going to happen, good luck.
Well, what you're saying then is that
they're probably undervalued. Yep.
In opposition to Larry Kudlow, whose earnings are the mother's milk.
Yeah, he hasn't managed money for an extremely long time. Can you hang on for a second, John?
Sure.
Hey, you're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And we're back. Hey, John, you still there?
Yes.
Okay, so during the commercial break, I looked up a couple valuation ratios. Valuation ratios is kind of like price per square foot in real estate or price per square yard in carpet. The higher the price, the more highly quality things are supposed to be.
Okay.
The United States stock market sells at 2.5 times its book value. That's the asset value, which is actually within 10 or 15% or so of normal. It could get a little higher than that. Normally not a whole lot higher than that. Typically it resides a little bit lower than that. But the Hang Seng is below its price to book value ratio for the first time since 1998. So they've had all kinds of problems there with currencies and whatnot. And that's one of the difficulties about investing internationally. It's not just the companies that you have to worry about and their economies, it's the exchange rates. So the exchange rates, if people are anticipating, and if investors are anticipating that the exchange rate is going to be pretty negative on all the companies there, their prices will go down. And there has been a lot of selling in that index lately. So, that would explain a lot of what they're thinking there. Now, the tried and true value investor goes, aha! And he starts buying, but he probably started buying in 2011 because it was close to that level at that point in time. And since then, it's just gone sideways. And then lately, it went down a little bit more. So you're looking at a 4-year time period where you've got a slightly negative return. And that is not uncommon, especially for value investors. When they say you got to be long-term investors, they're talking about Methuselah long-term. They're really talking about, you've really got to be in there 5-10 years and not worry about underperforming, which is really difficult for most people to do. That's
interesting you bring that up about long term, because I've finally settled on 3 stocks that have been doing magnificently for me.
Mm-hmm.
And I've been making 16% a year for the last 3 years. And prior to that, for 7 years, I made 11%.
Do you know what their price-to-book ratios are?
Yeah, in the 25, 28 range.
The price-to-book ratio?
Well, let's see. I'm sorry. I'm talking about the
price to earnings. Yeah, that's what you're talking about.
Yeah. That's
sure.
right.
Okay, that's a little bit high. It's not super high.
But these stocks go back to, they all started in the 1870s.
Yeah, well, if they started that long ago and their price to earnings ratios are above 20, it wouldn't be uncommon for them for the next correction that comes along to drop 40 or 50%. That wouldn't be uncommon at all.
Well, all I can say is that you look at their chart for 10 years and beyond, and
give me one of the symbols.
AOS. And it goes from bottom left to upper right for a long, long time.
Yeah.
Even Apple and the others go up and down like roller coasters.
Oh, they all do. All stocks do that. So in 1998,
well, these have kind of not done it. Except to a very limited extent.
Okay, let's talk about that. 1998, the stock was $5.78. Okay, and in 2009, it traded back at that same price again. So if you're not upset by an 11-year
it has split 4 times.
No. That's adjusting for all the splits. So that stock had an 11-year period where it had a negative return. If you're okay with that, so am I.
Well, let me say that.
I'm looking at the screen at the stock.
Tell me what it did in the last 3 years.
Oh, it's straight up. But we're talking about super long term, right? And in 1994, I know AOS very well. It's a very large company. It's a good company. There's no doubt about it. In 1994, the stock traded at $4.45 if you adjust it for all the splits, and it got back to that level in 2009. That's what I'm talking about.
Well, I was going to say that in 2008, 2009, that's when everything dropped.
Oh, absolutely.
I mean,
but it doesn't.
Nothing stayed the same then.
And it doesn't make you feel any better, though, if you've held on to that stock since 1994, and in 2009 you're actually below what you paid for it. If you're still alive.
Well, what I'm saying about this particular stock is that
it's had a good run. What you're doing is
back.
Well,
it'll come back.
It will. And if you live long enough.
And the revenues are 85% of the revenues are replacement. And you know that when your hot water heater goes, you don't go shopping around. You say, "Hey, I want a hot water heater now."
Here's the thing.
They basically have some pricing power too.
Well, they've always had pricing power. I know that company really well, and I'm just telling you, it's a stock, and all stocks at some point in time are going to drop by at least 50%. All stocks. There's not a single solitary stock that's been around for 25 years that hasn't been down at least 50% at least once.
Well, it's been outperforming many, many stocks greatly. So, again, Apple is basically where it was 3 years ago.
Apple hit a new high.
I know, but what was it 3-4 years ago?
Here, I'll pull it up for you. Actually, Apple peaked 2012 at 98. It went down to, looks like 57, got up to 118, 2015, comes down to 91, and now it's at 148. So it's actually at an all-time new high.
Yes, but it was up not too many years ago, and then it went down, and then recently it went back to where it was a few years ago.
No, and actually it's higher than it was 3 years ago.
I know, but what I'm relatively speaking. In other words, if you would have invested in Apple 4 years ago and invested in the AOS 4 years ago, I think.
Yeah, but see, you're going to have that though. That's not uncommon. That's why so many people don't do well in stocks.
Well, that's why I dropped Apple, because I'm tired of the roller coaster when they say they're going to sell 50 million phones and they come up at 49.5 million and the stock drops.
Well, as long as you're,
I'm wondering if it's fixed, because
No.
the estimates are made by who?
yeah, it's not fixed. Believe me,
Who makes the estimates of the phone?
there are several firms out there, and there are lots of brokerage firms, research firms. And by the way, if you track that stuff, yeah, a lot of them, you're trying to predict the future. So it's not easy to do. It's really not easy to do. And I'm just telling you, any stock, and you pick out a stock that's done well over the last couple of years, that's a big mistake that an awful lot of people make. And if I get a chance during the next commercial break, I'll go and look up the fundamentals on AOS and tell you what the current fundamentals are. But all stocks, I hear this, I've heard people like you my entire career. They come in and got a stock and it's done really well over the past 4 or 5 years, had the best 4 or 5 years it's ever had, and they project that into the future like it's never going to change. And I got to tell you, they all change. They all change.
Well, the way I read things, it has done much better than most stocks.
It has, but you're looking in the past, and that's,
I understand that, but the past is many times a preview of the future, too.
Oh, well, you know what?
Now,
if
there
that
are
were
two
true,
other
every
stocks.
librarian would be rich.
I understand. All I'm saying is, in my investing, I have done much better with the three stocks I have now. By the way, one of them is going to be in play today, so to speak, with Kentucky Derby, Churchill Downs, CHDN. And my theory there is that in another 150 years, I think everybody's still going to be betting on the Kentucky Derby.
Oh, they will. I really wish you luck on this. I hear what you're
Cedar
saying.
Point also,
Yep.
fun, FUN.
Yes.
That's another one, and it gives like a 5% dividend, too.
I hear what you're saying, and by the way, I've seen that stock get clocked by 75%. But
and I've seen GM have a plant taken over by socialists in
absolutely.
Venezuela, which will not happen with Cedar Point or Churchill Downs or AOS. So I feel safer there also.
Yeah, well, that's good. Just don't put all your money in it.
No, I don't put it all. I split it. But
yeah, just don't put all your money in any one stock. And what you're talking about, I put a guy in 5 stocks back in 1996. Okay, because he had this money and it was expendable money, meaning he could lose the whole thing, and it wouldn't bother him. It wouldn't affect him one way or the other. And it was $125,000. And a few years later, I think it was 1999. Yeah, it was 1999. He calls me up. That money is worth $525,000. And he calls me up, actually I called him up and I said, hey, you know what? These stocks went way higher than they should have. They shouldn't be selling at these prices. And he goes, no, I think I'm going to hold it. So it goes up another couple $100,000. And he calls back. He says, see, I told you. I go, yeah, well, they were overpriced when I called you. Now they're really overpriced. So he held on to it. That portfolio dropped all the way back down to $200,000.
That's happened in real estate in Florida.
Well, that's what I'm saying.
Everything. Seems like they're always creating another bubble right after the previous one.
Here, an AOS has a price to earnings ratio of 28. It's got a price to sales ratio of 3.5. Me looking at that, I don't like that. What I'm seeing, I would much rather buy that stock when its price to sales ratio is around 1, because that's its long-term average. So it's a lot higher than it has been, and it's probably because profits have been better than they have been. And now let me see, gross profitability, 40% profit margin on it is 11.5%. That stock is overvalued. But it doesn't mean the stock can't double. Remember what I said? That guy, his portfolio went up another couple $100,000. That's the part. That's the part that you can't predict. You can't predict that.
Let me ask you one more question, at least, about the institutional ownership. Now, this one is 94% owned by institutions. What is the significance of that? Because I know Apple and many other well-known stocks are maybe in the 60% range.
Most of them are a lot higher than that. The individuals own very little of stocks today. It's about 95% of all investing is done by institutions anymore. So it's not that significant, if you ask me, because first of all, they only have to report that every few months. So you really don't have any idea on from one day to the next how many institutions are, which ones are buying or which ones are selling. That's one of the reasons I look at charts, but that's a whole nother story. But the institutional ownership changes so quickly that by the time they publish those numbers, they've already changed.
Yeah, I kind of understand that based on the what is it, the 13 Fs or whatever that come out every 3 months.
Yeah, it's a lot of the holdings, and then you've got other institutions that invest as well. Hedge funds, a lot of those guys have to report too. So, and you just don't know. And like I said, that the individual investor makes up such a small percentage of the daily trades anymore that almost all the shares are owned almost completely by institutions. And it's really one of the reasons that trend following has had a tendency to work in the past, because those guys are kind of stuck. They're all fishing in the same pond, and it's tough. Look at the top holdings. Pick up a fund family, T. Rowe Price, Vanguard, Fidelity, you name it. Pick up their top holdings in their top funds. They're all the same. You see a whole bunch of overlap in those funds. And that's one of the reasons that a professional investor can help you, because I can pull up the holdings in those, and you don't have to buy the same holdings in 3 different funds and feeling like you're really diversified. That's something that a lot of people go through. They have that experience. That doesn't feel good. By the way.
Now, 2001, in that time frame, Mr. Schwab was saying that stay away from dividend stocks. And 10 years later, it was like he was 180 degrees the wrong direction on that.
Well, he was a little early. He should have waited about 2 years, which is really not that bad when you look at the long term of the stock market. That's what kills everybody. When you're talking about long term, look at stock charts. Long term, it means really long term. Long term is not a year or 2 years. Long term is 5 to 10 minimally. So to be within 2 years, that's actually not that bad. There was this guy, and I forgot his name. He passed away not that long ago. He was the head of the investment department, one of the big brokerage firms. What the heck was his name? Shoot. Anyway, I'll have to go back and get his book. Anyway, this guy was right on spot. He was calling the top in the market, and they literally, the firm that he was working for, they took his position away from him and put him kind of out to pasture. They didn't fire him because they knew he would sue him for that. But they kind of put him out of pasture, didn't give him any power, because he was calling it near the end of 1999 for people to raise a significant amount of cash. Near the end of 1999, he was only 3 months early. 3 months later, the market started dropping and didn't stop until it was down over 50%. And the S&P did. A lot of your value-oriented stocks, by the way, did pretty good. But it's just everybody's got opinions. Short term really is anything less than 5 years.
Okay, another question here on the. When I started investing, I was looking at Chinese stocks, and boy, did I find out in a hurry that their accounting practices were like.
Yeah, that's one of the reasons I don't. If I'm going to do.
Has that changed at all for the better?
I don't follow it, because if I'm going to invest internationally, I'm going to do it through a fund. Those guys are paid to know the differences in the accounting in all those countries, and most countries do have their own regulatory bodies that have different rules. So you really need somebody who's specializing in that. I wouldn't do that on my own. That's not within my area of expertise. I try to stay away from that and farm that out to somebody who knows what they're doing in that area. A lot of those guys have trouble keeping up with the indexes too. But hey, I got to take a real quick commercial break. Okay. Thanks for calling. Have a good weekend.
You too. Thanks. Bye.
You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And we're back. Hey, thanks for calling. I forgot what the guy's name was, but John. because that's a pretty good call. There are a lot of things that I've seen and heard before. People come in, they got a stock and done well with it, and the market's actually done well. You look at what the S&P's done since 2010, it's up a lot. So they get excited. I would say that you probably need to diversify that out. I hate when they have to learn that the hard way. That is brutal. Get a big concentrated position, 4 or 5 stocks, and they do well. And in a lot of cases, people will have a lot of money in one stock that does incredibly well, and it just gives them a false sense of security. You need to spend some time looking at some long-term charts on stocks and looking at how much they fluctuate. And some really good companies fluctuate a lot. So that's what we're talking about this seminar. How do you come up with a strategy that will fit within your own personality? How much risk do you really want to take? You're holding 5 stocks in a portfolio. If you're down 50, at some point in time, you will be down 50%. It's just a matter of how long you live. Yeah, it's not an if. That's a win. So if that's not the kind of risk you want to take, then you got to figure out something else. And we'll give you a couple of those options that you can use. And by the way, you can use that in addition to it. I love investing in individual stocks. I think it's fun. It's a challenge. But most of my money is in a portfolio or portfolios, different types of portfolios, based on what they do, what those portfolios do. And I understand it very clearly. I'll give you an example. One of them, I take the top 500 companies just by size, and I split it up into the 10 major sectors according to the Morgan Stanley. So actually there are 11 sectors now. So I split it up into the 11 sectors that they say, okay, these are the major sectors that make up the stock market. And then I pull out the 4 with the highest dividend yields. That's what I do. So it's 44 stocks. Used to be only 40 because they had 10, and they split the financial into real estate, split the real estate out of the financial. So anyway, it's 11 sectors. Not a huge change, by the way. I know why they did it. And I'll show you why they did it at my seminar. I don't have enough time to talk about it today, but I know why they did it. Anyway, so that's the strategy. Take the 4 stocks from the biggest 500 companies in the world that have the highest dividends from their sector. And then every quarter we go in, or at least once every 6 months, we go in and we rebalance that. What's rebalance? Rebalance means we're going to add to stocks that may have dropped, whose dividend yields are now higher. We're going to sell stocks if they have cut the dividend over the last year or so, and the dividend yields no longer high. And we're going to also cut stocks that may have gone up a lot, whose dividend yields now have dropped. And that's one of the strategies. And I really like that. It makes a lot of sense. You look at the past performance, it looks very good. And I really like that a lot. So we'll be showing all that kind of stuff. And there's some other strategies. Actually, the strategies that have not done well the past 3 years are all based on momentum. And that's very cyclical. Momentum is very cyclical. I'm not sure if the momentum models will ever work again. They've never worked well when GDP growth has been below 3%. I can tell you that. Yeah, and we haven't had above 3% GDP growth. So when we get above 3% GDP growth, if we ever get there, maybe those strategies will come back. And so I had to go back to the drawing board and say, hey, this may be broken. This model may be broken. What do you do when you have funds in your portfolio, even if you know what they're doing, but they don't seem to be working? What do you do? How do you decide when it's time to go? I don't have time to get into all that today, but I will be covering it at that seminar. How do you know when it's time to go? Because that is a tough call. It's a really tough call. And I've got a method. I've been kind of using a version of this my entire career, and it's just, I thought it was common sense. And now some academics put a little math behind it, published a paper, and now everybody's doing it. So it's pretty interesting. How do you know when your model is broken? That's part of the process of having a strategy that suits you. You have to monitor what you're doing. It's not a set it and forget it. You set it up initially based on what your goals are, your age, your income levels, the need for income, all that stuff. Okay? And then you monitor that. And by the way, it should change as you get older. As you get older, you typically don't want more volatility, although it depends. I have some school teacher clients who get enough money on their pensions that they're saving money every month. So they're not even spending what they get from their pension. They could do whatever they want with their money. It doesn't matter. It's not going to affect their lifestyle one bit. But if somebody were dependent on the income from that and they need to take out 4 or 5% a year, they have to be really careful how they're investing that money. Does that make sense? Because that's what the whole idea of the seminar is about. How do you figure out what is right for me? How do you do that? And I've got a lot of material I haven't shown before, which is kind of interesting now that we're only down to 20 seats remaining. I'm watching this on my laptop in the radio station. How many people are signing up for the seminar? It's unbelievable. The technology today is mind-boggling. Anyway, so watching that, and got 20 seats left, and some data, like I said, that I haven't brought out at any other seminars before. I'll be using it in the future for sure on an ongoing basis, because this stuff, not only is it important to you with the new Department of Labor law, it's mandatory. It's important, and now it's mandatory. So if you're a fiduciary, you have to do this. And I'm a fiduciary. A fiduciary is somebody who has to operate by law in your best interest. That's what a fiduciary is. It doesn't mean I have to be perfect. It means I have to do my very best. And if I don't think it's in your best interest, I'm not allowed to use it. Okay. Big difference between fiduciary and an investment advisor, especially a regular investment advisor that sells commission product. So I think people should probably know a little bit about that, why that's important, what we're doing, and it's a good idea. So anyway, I've just about ran out of time here. I got a few minutes left on the program. You can always call the office too, 330-664-0700. Just go to my website. The number's there. You can contact us there too. It's Bullington Capital Management. Website will be changing a little bit over the next couple months. I want to pay attention to that a little bit. I think we're going to put another tool on there, and I think it'll help people. And so that should be interesting. The Lookout for the Bull website is up now. That's the trend following one. That's the opposite of the value. And I was talking earlier today about the two extremes of investment styles. One is a value oriented. The other is a growth momentum or trend following. Trend following would be the extreme on growth there. Is it really not paying a whole lot of attention to the valuation on stocks, just how fast they're moving? And that's the extreme. That's the extreme end. On the other extreme, you're looking at companies with the highest dividend yields. That would be the dividend model. That's an extreme. So I'm going from one end to the other. And why do I do that? Well, because I have multiple personalities. and it's kind of fun. And I learned how to do it. So it's very fun. In fact, on Friday, there were 59 stocks that came through all the scans. That's a lot. That's a lot of stocks for one day. That is typically not like that. So there were some pretty good names out there too. I'll just go really fast through the Live Nation Entertainment, LYV. It's got a price to sales ratio 0.77. That's not super cheap. It's also at a 52-week high, right around $34.55. And had huge volume, was up big that day. By the way, the chances of these continuing to go are only 50-50. But here's where it gets interesting. If you're cutting your losses at 15% or less, occasionally you're going to get one that goes up a lot before it turns up stopping you out. And if you only put 10% of your trading account in that stock with the 15% trailing stop, you're only risking 1.5% of that principal of that account. And that, by the way, is the magic. That's the trick. It's not picking the right stocks. Whether this one's going to go or not, I have no idea. All I know is it's going up really fast right now. I don't know how far it's going to go. In fact, that's an all-time high for that stock. And just past, I guess it was past couple of years, it got above its all-time high that it reached in 2007. And after crashing, when the whole stock market crashed, and the long-term chart on that looks like a cup and a handle pattern that William O'Neill writes about. Anyway, this stock is blasting off, and it's got a pretty decent valuation. And the thing I like about this type of business is Live Nation Entertainment. Watch it crash because I brought it up on today's program. That's my luck, by the way. And I'm still profitable doing this, which is very interesting because there are very few people who have luck as poor as mine is. And anyway, that's one of those stocks that could be a top. If it's a top, it might cost me 1.5% of that portfolio that I have in there, and big deal. I'd make that back up, lickety split. And I would probably just put that stop at 10%, the initial stop. That's what I would do. You have choices. We'll talk about those later. This is something that we'd also talk about at the seminar. And I did buy one on Friday. I bought it on Friday. And this is Health Insurance Innovations, HIIQ. I bought it at the open. It's up a little bit for the day. Actually, it's up 5.5%. 52-week high, which is pretty good. It's this stock has not been public that long. I've been noticing that a lot of the healthcare companies have been coming up on these scans. So what that tells me is people are anticipating that there's going to be a change. Everybody's watching the new healthcare bill that's out there, and stocks won't wait until that gets settled before they start running. Okay, if it starts running and it's interpreted, I just ran out of time. Oh well. We'll pick this conversation up next week. Thanks for listening, everybody. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, good investing, and good luck.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.